Hi everyone, I'm Caroline from Mortgage Choice in Fortitude Valley in Ashgrove, and I'm here with the fabulous Renee and Keely. Thanks for joining us in navigating the mortgage maze. A lot of people feel confused or overwhelmed when they start looking for a mortgage with questions like, what are the next steps I should take? What questions do I ask? Which structure is right for me? And how do I navigate these options and filter out which loan is right for me? Being well informed is the key to making the right decision. Today, we have a diverse audience attending or watching later. We have first-time buyers, investors, and commercial borrowers. We're going to briefly address some of the hurdles our clients have come across at each of the different stages of their journey, with examples of how we've overcome them.
Hi, I'm Renee, and let's be honest, loan lingo can be like another language. And on top of that, it can feel like you need qualification to figure out what is going on. We like to describe it a bit like speed dating. When you think you found the right one, you realise you don't meet the lender's requirements.
Hey guys, I'm Keely, and this webinar is designed to cut through the confusion. Whether you're looking to buy your first home, sort through options, or just understand why borrowing feels harder than it should, we've got you covered. Throughout the webinar, you may have questions you'd like to ask. Please pop these through to us in the Q&A function down the bottom of the screen under the 9 dots. Q&A, and we'll answer them at the end.
Entering the maze, we're faced with hundreds of mortgage products, different loan types, and jargon that is brand new to our vocabulary. You'll not find a one-size-fits-all loan, and it can make things confusing if you don't know which way to turn. The very first step you, as a borrower, must take is to get clarity on what you want to achieve and why. This is important because structuring your home loan and choosing the right product depends on the end goal. Once you have clarity on the final destination, the path becomes clearer. Most homeowners begin by buying their first home, then progress into leveraging the equity to expand into building their investment portfolio, upgrading to their dream home, or even investing in a business.
Once you have a clear goal, we set a strategy with you, starting with education. Understanding lender jargon is the foundation of good decision making. Lenders' products and policies are based around loan-to-value ratios. LVR, or loan-to-value ratio, is the amount of loan compared to the property value. LVR is important because it determines the risk for lenders. For example, if you buy a $500,000 property at 95% LVR, meaning your loan amount would be $475,000. Should the value of the property go down and the loan go into default, the loan amount, including penalties, may exceed the value of the property. If the bank needs to sell the property, the loan won't be repaid with the proceeds of the sale. This is where we introduce LMI, or Lenders Mortgage Insurance. This insures the bank against default. The premium is paid by the borrower and can be added to your loan amount. This is a great tool to enter the market sooner than if you were to left to save for a 20% deposit. Loans over 80% LVR generally attract an LMI.
LMI is often given a bad rap. And why wouldn't it when the money goes directly to covering the bank? You can see why. However, as Keely mentioned, it can be another tool to help you break into the market sooner. So both my first and second homes had LMI rolled into the total amount. For my first home, this enabled me to retain some of my savings so that we could use that extra money to go towards new furniture for our property. And then we also were able to retain a small cash buffer for those emergencies that came up. When I purchased my second home, we'd relocated from Townsville and had used a chunk of our savings in the move, and we hadn't quite built the savings up yet. An opportunity arose for us to buy a block of land and to build. To allow this to happen within the time frame of this being available, our broker recommended going into the LMI territory so that we didn't have to wait to build our savings up again and potentially miss out on this opportunity. What this has meant is that today, 5 years later, we now have a home that we purchased at a much lower price than what we would be looking at today, and we don't need to be worrying about the rental market or paying more for that exact property. In this time frame, we've also built up enough equity that on a couple of different occasions, we've been able to use some of that equity for debt consolidation. And then most excitedly, buy a new car and caravan last year so that we can live our retirement dreams a little bit earlier.
It's a similar story for me as well. When I first entered the mortgage maze and was looking to buy my first home, I just felt it was an ever-moving goal to reach an acceptable deposit to get into the market. At the time, we were not eligible for the schemes offered, and I was starting to lose hope that I would ever get my first home. We then decided to speak with a mortgage broker, thinking it can't hurt. This is when things started to look up. We were educated about LMI, and at first it seemed like a lot of dead money. But after the loan settled and we moved in, that feeling of moving into something we could call our own was incredible, and we quickly forgot about the LMI. To this day, I still believe it was the best decision I ever made. Step forward 10 years, and my house has doubled in value. And now what felt like a lot of money at the time seems so insignificant. So let's dive into buying your first home. There is so much stigma around entering the property market as first home buyers and needing a 20% deposit. This is strongly driven by social media, which, surprise, is not always full of factual information. There are many first home buyer concessions, schemes, and tools that can help you get into the market sooner with a lower deposit. We don't want you to give up now or in the future for your property plan. Overwhelm is real. Thankfully, you don't need to spend your time knowing the ins and outs of government and lender policy. As your broker, we've done that for you and here to guide you through it. Now that we've spoken about LMI, another set of tools you can navigate through the maze of government schemes. There are both state and federal schemes available, many of which can be used in conjunction with each other. Here is an example of how LMI and government schemes can support you in the market sooner. Say you're looking to purchase a property in Queensland for $700,000, which is currently the maximum you can spend under the first home guarantee scheme. One of the government schemes is currently available. This would require a minimum deposit of $41,000. If you have been making additional contributions to super, the First Home Super Saver scheme allows you to access these funds to be used as it is worth looking into if you need a little more to get into the home. The First Home Owners Grant is also available for $30,000 that you, when you purchase a new home, thanks to Mr. Christopher Lee on stamp duty, is no longer payable either. So you've overcome the initial deposit hurdle, possibly using government schemes in your savings. Now looking at your income, we've hit another hurdle, the income threshold, meaning you're no longer eligible for the first home guarantee scheme. Mortgage insurance is now up. Hello, LMI. There are different paths that can be taken from here. One path is to increase your deposit by an additional $28,000, keeping your purchase price at $700,000. Remembering this can come from several different places. Get from a generous family member, my mum and dad, might just get you over the line. The LMI premium charge in this scenario would be rolled into your loan and paid off as part of your loan repayment over the life of your loan. It's an upfront payment paid once as part of your initial loan. And as described by myself and Renee earlier, we both utilised LMI to secure our properties, and 10 years on, we would do the same again.
Okay, so you've got a strategy in place. You know the basics of where your deposit's coming from, your loan amount, and now it's time to cover off the type of loan you want. We will guide you based on your personal circumstances, but briefly, loans are broken down into a few loan categories. You've got a basic principal and interest loan, which is a low variable interest rate loan, meaning the interest rate will move with the market, so repayments will generally change as the reserve bank leaves. You make repayments to pay the loan off over a period of time, generally starting at 30 years. If you want something a little bit extra, there is also a variable rate loan with an offset account. This is like the basic loan, but it has a savings or transaction account linked to it, which the balance then can reduce the amount of interest that is charged to your loan. Some people like the security of a fixed interest rate loan. This is where, for a period of time, usually between 1 to 5 years, there's an option to lock that rate in, securing not only the same interest rate, but the same repayments for that period of time. There are two different types of repayment options as well. Your main one being the principal and interest repayments, or P&I. This is where you'll pay off part of the original loan or the principal plus interest each month you make a repayment. The other option is interest only. This is a reduced repayment which requires only the interest charge to be paid for that month. Keep in mind though, this doesn't pay down your original loan amount. Most people will utilise this more so for investment loans.
Some other jargon you might come across is line of credit, which is like a big credit card and great for those who need access to credit quickly and can repay. However, these products attract a much higher interest rate. Offset accounts are often part of a package, attracting an annual fee of between $250 and $395 per year, as these include credit cards and discounts on other products such as insurance. You'll also hear us talk about owner-occupied. This is the loan you use for the home you live in, and investment loans, which is any loan you use for investment. For example, buying shares, business, or property. It's important to understand that the ATO determines tax deductibility by use of funds. You need to use the funds for investment purpose in order to gain tax.
We're going to take the next step through the property roadmap and touch on investment loans. Property investing can be a highly rewarding venture and one of the most powerful wealth building tools available to Australians. So why invest in property at all? Well, for me and most people, it's about building long-term wealth through capital growth and rental income. And to do that smartly, the structure of your investment loan plays a huge part in your overall strategy. As Renee and Keely have shown through their own personal experiences, with their first home being owner-occupied properties, both have significantly increased the value of their properties by having them over the past 10 years. This is known as capital growth. So you're now in the same position. You've got your owner-occupied property and you want to know, what do I do to get into the investment property maze?
One of the most common questions that investors ask is, how do I start? Where does the money come from or need to purchase an investment property? The most frequently used tool for this is equity. But what exactly is equity? So equity is the difference between the value of your property and how much you still owe on your loan. So for example, let's say you've got a home worth $800,000. Your mortgage on that home is $500,000. You can go up to 80% of the $800,000 value, taking away the loan, meaning you've actually got approximately $140,000 that you now can use towards a deposit on your next property. This allows you to not touch your savings and maximises your taxation benefits, as you would be looking to borrow an investment purchase price plus the cost. There are two ways to access your equity. The first one is to take a separate loan for the cash required for the deposit, which would be secured by your existing property in a standalone manner. A separate loan secured by the new property for the purchase is then submitted in a separate application. The second way is to access the equity through cross-collateralisation using multiple properties. This allows the LVR to be calculated based on all the security values and all the loans across these properties. We find most of our clients require their loans to be flexible and manageable for not only them, but also for their accountant. Of these two options, we recommend setting up the two separate securities and loans, as this will provide you with greater flexibility and safety to our clients if they need to make changes to their loans or their plans in order to reach their next goal. Using equity, well, it's like giving your money a job to do. Rather than letting it sit there quietly, you're putting it to work by building up your portfolio. So, if you have sufficient usable equity in your current property, you don't need to save separate cash deposits. The equity acts as a deposit. Keep in mind, though, that lenders will still assess your overall borrowing capacity based on your income, expenses, and other debts. This is to ensure you can afford the new loan, so even with equity, you still need to demonstrate that serviceability. Okay, so you're sitting on some true gold in your current property. Let's go shopping. However, you need to make sure that from the outset, your loan structure is correct. When it comes to investment loan structures, flexibility is key, and keeping loan structures separate to ensure the ease of tax reporting and flexibility to meet your future goals will make your portfolio. One such tool to do this is through interest-only loans. With interest only, you're paying just the interest for a set period of time, which is usually somewhere around 1 to 5, and you're not paying the principal. This allows you to not only have lower monthly repayments, which can free up some cash flow, it potentially allows more money to be put into additional investment or renovation, or even towards paying off your own home a little quicker. It may also improve your overall return in the early years of your investment. It's not for everyone though. For some, paying down the debt sooner makes more sense. It comes down to your investment strategy and tax position, which is why your broker will ensure that you and your accountant or financial planner have that long-term investment strategy decided. Another common term you'll hear thrown around a lot in investment circles is negative gearing. Negative gearing is when the cost of maintaining your investment property, which are things like the loan interest, your maintenance, your rates, are actually higher than the rental income you will receive for the property. So on paper, your investment is actually run at a loss. This loss can be used to reduce the taxable income. It is important to understand in this situation that it's not a tax benefit. That it is a tax benefit and not a profit strategy. It can be very useful in your early years of investment when that cash flow could be a little bit tighter. It relies on your property increasing in value over time for the strategy to really work. On the flip side, positive gearing is when your investment property is making you a profit after covering all the running costs. Your investment property can also be geared where the rental income covers the costs with no loss or profit to you. The right strategy for you? Again, this will depend on what your income goals and how long you plan to hold the property down to.
All right, let's get dived into complex lending. Once you have your first investment under your belt, you might get a taste of something more adventurous. This is where we can jump into the world of complex lending, commercial loans, and utilizing SMS. Caroline is our expert in this section of the maze, so I'll hand it over to her to explain it a little more.
Thanks, Keely. So complex lending is any loan scenario that goes beyond the simple individual borrower buying their family home situation. It usually involves multiple borrowers, maybe business partners, family groups, non-standard ownership structures like trusts, companies, self-managed super funds. There's also specialised security types like commercial property, rural land or construction. There's complexity around income, being self-employed, multiple income sources, foreign income or inconsistent income. There's also loan purpose complexity. If you're buying multiple properties, using the funds for business use, building investment portfolios, or putting the money towards property development. And then there's credit policy challenges. Imperfect credit history. So maybe you've got some poor behaviour or defaults or late payments on your credit history. There's often unusual expenses. Maybe there's extra things that are temporary expenses, or you spend your money in different ways that a standard lender won't accept, or bespoke repayment strategies. Let me give you a taste of some of the that's not even a hard word. Common examples of complex lending. We can start with trust lending. These loans are for discretionary, unit, hybrid, or corporate trust. There's self-managed super fund borrowing, when you borrow within a super fund using limited recourse borrowing arrangements, or LRBA. Commercial property finance, where you're buying a retail, warehouse, or any security used by a business. It usually presents higher risk lower LVRs, so you need more capital to buy into this commercial property, and often increased costs and valuation fees. Bridging finance is used when you sell your existing home after you buy your next home. This accommodates the current loan you have on your existing home plus the entire cost of buying your next home before you sell the existing. It's usually used for downsizers or for securing the property without relying on selling your existing home first. Self-employed borrowers are often lumped into complex lending because their income structures can be complex or through multiple structures, companies, trusts, and then individual income as well. And they can often be frustrated by income verification issues, add backs, business expenses. Knowing how to read financials and getting the most out of them is where our skill lies. You can also buy multiple investment properties or own multiple investment properties, and that can introduce complexity into servicing. Lenders often introduce tighter policies for investors holding more than 4 properties. Expats or non-resident borrowers is another complex lending scenario where foreign income is accepted only by niche lenders and mostly sensitised to allow for exchange fluctuations. There's also guarantor loans where, for example, a first home buyer or business owner guarantees the borrowing against the business, or a guarantor for a first home buyer offers their property up as additional security so that the first home buyer can get into the market sooner. There's more parties on the loan and the risk is often split across many generations. It's important when navigating the maze of complex lending to make sure you have a trusted and experienced expert on your side. Every lender treats complex scenarios differently. If you don't know lender niches inside out, or if you miss a structural detail like a trust beneficiary issue or SMSF deed rules, you could end up wasting months applying to the wrong lender, get rejected even if you have solid finances, or miss better terms that suit your structure and strategy. Expert brokers like us know how to pick the right lender up front. They structure the deal to match the lender appetite and preempt questions before any issues become problems. Keep in mind, complex lending isn't just about how much you borrow. It's about how you're set up to borrow. Getting the structure right from the beginning can make or break your financial structure or strategy later on. Complex lending, by its very nature, presents significant complexities. It's important to acknowledge that feeling overwhelmed by this subject matter is entirely understandable and a common sentiment. Lucky you have us on your side. Now let's examine some of the key aspects of this type of lending. Self-managed super fund borrowing, or SMSF borrowing. It's an area of difficulty. The area of difficulty comes along with the structural subtleties of borrowing through a superannuation fund. It's important, actually, clients frequently inquire about the possibility of simply establishing a fund and securing a loan. But it's really important to already have spoken to your accountant or financial planner, because they're the ones that are going to be able to coach you around whether or not it's the right decision for you. A lot of people already have a significant amount of money sitting in their superannuation fund, and they see that as a way to get into the property market. It may or may not be right for you, and this is where it's really important to speak to the right professional about it. Potential pitfalls in this area include the prior establishment of a self-managed superannuation fund, as opposed to an industry fund. If there is an existing loan in the self-managed superannuation fund, it introduces additional considerations. It's important to understand limited recourse borrowing, and we can tell you about that. You need to understand also your borrowing capacity inside the self-managed superannuation fund, because it relies on contributions and rental income, not your salary outside of the super fund. A common issue encountered is that clients may not have consulted with their financial advisor or accountant, leading to a lack of clarity regarding the alignment of their borrowing with a retirement strategy. Having a discussion with your accountant or your financial planner before deciding on a self-managed super fund is really important if they're addressed early on. Next area is commercial finance. It's a fun and interesting field. First-time commercial borrowers may find the lending environment more rigorous compared to residential lending. In many aspects, they're actually more relaxed because it's not, it doesn't fall under the National Consumer Credit Policy, but there are different ways that lenders look at it. Key differences include with commercial lending, often you need a higher deposit. Sometimes lenders will lend you for a shorter loan term. There's often more stringent servicing requirements. However, they consider self-employed people from a different perspective when they're looking at the whole picture. It's also important to consider tenant risk in the case of investment property, investing in commercial property, because commercial properties or retail outlets can often remain vacant for extended periods of time. When a property is held in a trust or company structure, lenders require detailed information about the structure. They want to know about the beneficiaries. Sometimes they also want to know about or they need evidence of their current financial situation as well. If there is a corporate trustee involved, and also the nature of the shareholdings, whether they're beneficial or non-beneficial. These factors are crucial not only for the loan approval, but also during the most advantageous terms. Now, bridging loans is another area we're going to touch on. Bridging loans are when you acquire your next home prior to the sale. We addressed it a little earlier on. It can be stressful when you're buying the next property without selling your existing property, but there are products available called bridging loans. You may be bridging to downsize where you're not going to have any debt once you sell your existing property, but you need to have equity in your current home. Borrowers often worry about the contingency of the existing property not being sold within a time frame. So you've usually got 6 to 12 months to sell the property, and in a metropolitan area, that's not usually a big worry, but some country homes take an extended time to sell. The other issue that you need to think about is market fluctuations. You might buy your next home, and if the market declines in the next 3 months, you might be looking at a lower sale price for your existing home. This is often taken into account when we're assessing your capacity for a bridging loan. And in unforeseen circumstances, you might need to have to service or repay the peak debt, which is the amount of debt that you have when you own both properties. Now, the great thing is there are a number of lenders who do offer bridging finance, so they all look at it from a different perspective. Bridging loans are a great tool when they're well planned, but there is also risk involved if they're not, if your strategies aren't well planned from the outset. Now, with the right team, complex lending is really easy. Understanding structural frameworks, tax implications, legal risks, timeframes, and the broader context prior to proceeding will make it much easier. Education is really important, and this type of lending is intended for well-informed and strategic borrowers. Awareness of potential challenges beforehand provides a considerable advantage. Now, debt strategies are an important part of wealth planning, and having the right team in place is vital.
It really highlights just how many traps there are. Don't have the right advice or structure from the outset. The good thing is that while complex lending can sound overwhelming, it's absolutely manageable, as Caroline said, if you've got a team that understands the mechanics behind the loan and the structure you're looking to.
That's right. When people hear complex lending, they often assume it means the client is difficult. Sometimes they are, but it's not that at all. Complex lending just means there are more moving parts more entities involved, different types of income, more scrutiny on the setup, and the lender needs to be confident it all stacks up. So what's the difference between a smooth deal and a total disaster? It comes down to how well your broker understands the structure behind the scenes. You want to talk about trust lending, Keely?
Absolutely. Take trust lending, for example. We need to look at the trustee, corporate trustee setup, and things like who are the beneficiaries. Is the company trustee set up correctly? Are shares that are in the trustee held beneficially or non-beneficially? Because lenders assess those details very differently, and in some cases, it can determine whether you get approved at all. Same goes for SMSF borrowing. If your fund isn't set up correctly or it already has a borrowing in place, that can rule out certain lenders straight away. We need to confirm that the trust deed allows for a limited recourse borrowing arrangement, and ideally, clients should have already spoken to their accountant or financial planner, so we are all on the same page about the contributions, cash flows, and investment intent. Then there are questions of capacity. One of the biggest misunderstandings we see is this. People assume that because they can afford a standard home, they'll automatically apply for an SMS or commercial loan. But that's not how it works. Lenders calculate servicing differently for trusts, SMSFs, and commercial properties. Rental income might be scaled back. Super contributions are treated more conservatively, and business income can require years of history. So before clients even start looking at properties, they really need to understand what's their true borrowing power, do their structures actually support what they're trying to achieve, and is this aligned with their broader wealth plan? And that is why the details are so important. Complex lending isn't scary, but it does need education, planning, and the right professionals asking the right questions from the beginning.
Absolutely. This type of lending is designed for clients who are building wealth through property or business, whether it's in their personal names, inside super, or using company or trust structures to grow their portfolio. It's not for people who just want to get a loan and be done with it. It's for those who want to use lending as a tool, not just a transaction. So the more you understand the process, the better positioned you'll be to make smart, strategic moves that actually support your long-term goals. One great thing is that I've tried this all myself. We're borrowing for residential property, commercial real estate, business, self-managed super fund, and through all different structures. I've made the mistakes and I've learned my lessons. I've gone through the challenges and can show you how it's done. Now, before we jump to our Q&A section, I think one of the main takeaways from this webinar is no matter if you're a first home buyer or a next home buyer, that whilst we all want a lower interest rate, the best loan for each individual is really based on each individual's needs, both now and into the future. So make sure you think about now, your current lifestyle, and then how you see your future. And your future strategy is one of the best steps forward you could do. That's why brokers make a huge difference in guiding you through this process.
That's so true. It's important to remember that at the end of the day, we and all those involved in the finance industry are helping everyday Aussies borrow large amounts of money. Care and discretion is so important to ensure you're not put into hardship and are making an informed decision. It's probably a great time to mention that mortgage brokers are bound by best interest, meaning we are bound to work in your best interest. Additionally, our team are paid the same no matter which lender or product you choose to proceed.
Also, one thing I always tell clients is don't try and pre-approve yourself. Don't make assumptions based on your current situation. If you are a casual employee or maybe you have missed a payment years ago or defaulted on a credit card years ago, it's much easier to deal with the facts. We know what your situation is. We can put you in touch with people who can fix it, or we can just give you a reality check. We'll be able to tell you what you need to do to get to where you want to be. We'll be able to put you in touch with the right lender put your structure in place and make sure that we're achieving the goals that you want to achieve.
It's also about timing and preparation. So getting your documents in order, knowing what the lender is going to ask, and making sure you're loan ready before you apply. And we can help with that. So even if you're in the early stages, this is great. The best time to have a chat to us. There's no pressure from us, there's no jargon. We slip into jargon mode, we will explain what that jargon means. We'll give you the good advice that's tailored to you. If you're thinking this still sounds overwhelming, that's why we're here. Book a chat with us and we'll map it out together.
So we're going to be staying on now for Q&A. So pop your questions below. I can see a few have already come through, so we'll address those and any additional you may have. Thanks for spending your time with us. We hope you're walking away a little more confident and a lot more prepared. If you don't have time to stay for Q&A or would like to reach out to us directly, we've also popped a link in the chat box to book a discovery call. We've also got a copy of our Loan Ready checklist coming straight to your inbox as a thank you for joining us today.
Awesome. So one of the questions that has come through asks us to explain our investment property journey. Renee, would you like to go first?
I can go first. So me and my husband are relatively new to the investment property journey. I'll say again. When we moved from Townsville, we did keep our property up there for a short period of time as an investment, which was kind of very muddled because we really didn't know what we were doing that much up there. But we've taken the step and the plunge, and we're now looking at buying one off the plan, actually through one of our referral partners, which is due for completion in a couple of years. So we're pretty excited about how that's going to go. We've paid our initial deposit, and we're just waiting for the property to be completed so that we can walk through. So we're hoping that this is going to be the first of many. We're potentially also looking at getting one set up for ourselves, which we can as well.
That's exciting.
Can't wait. Is that pretty? I think I want to potentially say it myself.
So my first investment property, I knew I had to buy an investment property and I could borrow very little money. So I was looking for a cheap investment property. I had pre-approval and it was about to expire. And I just needed to buy a property as soon as I possibly could. So I went out and I bought, oh my goodness, the house. It had paint peeling off. I just went through. I looked, yeah, that looks all right. Signed the contract because my pre-approval was expiring. Very soon, so signed the contract and just bought it. I had minimal savings. I think I took it up to 95%. And I just needed to get into the property market. I was desperate. I knew I had to buy an investment property. So I paid the deposit. I got the loan approved. My pest and building guy comes through and he's like, oh, there's a bit of this and a bit of that. And I think he thought I was going to pull out of it, but I didn't. Because 2 years later, he said, did you really buy that property? And I said, yes. So 12 years later, it is still going strong. I painted it, but after a very long time, I think the back awning is held on by bungee straps, but the tenants don't complain. So it has gone up incredibly in value. I bought it at a time where houses were still affordable, and it just meant that I've been able to use the equity to buy additional properties as well. And it's been exciting. I've managed it myself the whole time. There's been the same tenants in there since day one. It's been a really fun journey. I haven't had any issues with them. I've loved going through the process of investing and seeing the joy, but also it was a hard time to manage the budget at the time as well. We were starting our family. The kids were really young. So it was something that I really had to be mindful about. knowing that every time an expense came up, I'd be like, oh, I really hope that awning doesn't fall off, that bungee cord holds, and they don't ask for a new bathroom. But over the years, we've been able to manage it really well and add to our portfolio. I've also bought in the self-managed super fund. At that time, it was a brand new property off the plan. Beautiful place. It didn't increase in value as quickly, but it certainly is paying off now. All right, next question, Keely.
The next question that's come through is, should I be looking at properties in the market or talking to a broker first? So this is really personal preference. Obviously, having an idea of what your borrowing power is in the structure you're looking to purchase is definitely a good first step before you go out again to set on zone and getting fall in love with those properties. It's really good to speak with your accountants as well as your financial advisors if you are looking towards those complex scenarios. Just as Caroline explained, there are a lot of working and moving parts involved, so it's important that they are set up correctly and you are educated and understand.
Another question that has come through is, how much do I need to save up for an investment property? Now, Renee touched on that earlier, and she mentioned that you could use the equity in your home. So you can actually buy an investment property without any deposit if you've already got a little bit of equity in your home, meaning you owe probably less than what you initially borrowed, or the property has gone up in value. So you can buy an investment property just using the equity in your home. You don't need to have any extra cash.
Might take the next one. So someone has come through asking, how do I know when I should jump into the investment pool after my first property? I think this also comes down to a little bit of, personal preference. It should be, I guess, a little bit comfortable. My thoughts around it are same as buying your first property or any property. My best time to buy property was yesterday. So even if you've just got that question running through your mind, my recommendation is come in, sit down, speak to us, and we can give you an idea of how close you are to being in a position to buy an investment property so that we can put those goals and plans in place to get you there as quickly as possible before the market does.
It's a bit like when's the best time to plant a tree? That was 20 years ago. And the next best time is now.
Yeah,
so
definitely.
I totally agree. Even though it's a really strong property market, especially in Brisbane, Brisbane's not the only market that you can buy in. So there's other markets around Australia that can be great investments at the moment. I did buy a property in Melbourne a couple of years ago, and although it hasn't increased in value, it's certainly much more affordable and returning much more rent than I could have got in Brisbane. All right. Really, you want to take this question?
This will be our complex expert.
So the next question that's come through is, what are your opinion of residential versus commercial property? So I don't have too much experience with this personally, so I will hand this over to our expert Caroline, who has done both.
Excellent. So residential property, you can leverage it and pay mortgage insurance. On commercial property, you can't pay mortgage insurance. You generally can go to a maximum of 80% on a commercial property, and you do need to allow for periods of vacancy. So in the residential space, the vacancy rate around Australia sits around about 1%, and that equates 1 to 2%, which equates to maybe 2 days of vacancy a year. It maybe allows for one turnover where one tenant moves out, they clean, and the tenant moves in a day or two later. So that's a really, really low vacancy rate. But when you look at the commercial vacancy rate, it's much higher. But on the flip side, commercial rents are generally higher and the tenant pays the outgoing. So it might, while the property is tenanted, it might actually be a lower cost for you to hold. If you're a business, buying the property that you are operating out of might actually be a really great strategy. So these are all the sorts of things that you need to speak to your accountant or financial planner about to make sure that you're making the right decision for your long-term strategy. Now, I think that we might wind this up here because we've answered all the questions, and the other ones coming in are probably along the same lines. Actually, this next one, rent vesting, would you like to address that?
Yeah, so rent vesting is definitely a hot topic at the moment on socials. I have had a few clients of mine that have been in a position where they're lucky enough to be living at home still with mum and dad. They've got a great income, looking to get into the market, but don't necessarily have the capacity just on their own income to look at purchasing an owner-occupied, or they love living at home with mum at the moment because it's a great location, close to work, all that sort of stuff. Mum does washing and cooking. So they've decided that, you know what, if they were to buy an investment property, they can look in other areas, as Caroline mentioned, where it might be a bit more affordable for them. I definitely have guided quite a few of my first home buyers down the rent investing path because it means you're getting in, you're getting a property at today's market, that property grows, you're building your equity, so you can also use that equity to then buy an owner-occupied property. So you don't necessarily need to do the owner-occupied first.
That's great advice. Excellent. Well, thanks everyone for joining us. You can look out for the checklist that'll come to your inboxes soon. And if you do have any other questions that we haven't answered today, you know where to get us. I've been Caroline, this is Renee and Keely, and thanks so much.
Thanks for joining us, guys.